Now we get to pivot to the U.S., and here you can see that we did get an increase, but when you look at the previous year, which is obviously 2021, you can see that the spike came a little bit later, and we will get a drop, and then we'll get one more spike, just because when you think about the drive and when people consume gasoline for this, it's really going to start to pick up Thursday, Friday, because of the winter storm, the rain. Probably picked up a little bit earlier, just as people try to get ahead of it. And then you have a lull, just especially because you have Christmas on a weekend, you have New Year's on a weekend. So that week is probably going to be fairly light as people go and then spend some time in their location. And then you'll get another increase as people come home after New Year's. And that's when you'll see that additional spike, which will normally come at the beginning of the year, just based on how the timing is on when this specific data is reported. So we will get we will get a drop and then another increase. Because things started a little bit later, we'll likely not get a drop, but just a slight increase and then a sizable drop as we go into the end of the year. And again, we just expect this to be very close to, on average, when you pull it all together, about that 14.3, 14.4 million barrels a day on average. You can see that the average is actually much lower right now at about 14.1. So we do expect a little bit of an increase, just given where we are, where some of the increase in demand just from gasoline and diesel. And then we do expect that to drop off pretty sizably as we go into the beginning of the year, and will likely track something closer to about 13.7, 13.8, just because January is a very slow part of the year, and you can see that from previous years. So we just expect to be normal in terms of where we are, but about anywhere between 700,000 to 1 million barrels below where we normally have been between 2017 and 2020. And I say 2020 just because things didn't, go to hell in a handbasket till we were in April, March into April, which is why things were just going to be closer to where we kicked off 2022 for the most part. So now when we dig in a bit, distillate had a small drop of 240,000 barrels. That's 9.8 million below the 5-year. Again, all driven by Pad 1. Pad 1 did have a build of 1.27. Pad 3 had a drop of 1.32 million. Pad 3, or the Gulf of Mexico, was really driven based on just the amount of exports. There's a lot of exports that continue to come through. Now, imports were sizable last week, dropped this week. They should stay a bit elevated and really come back closer to that 5-year average, just because there is that demand following the fairly sizable cold snap that has hit most of this country. And it'll warm up a bit, but they're going to have to refill their heating supply, which is why we should see storage stay fairly flat versus where we have been in the past. As we said last week, we expected to see a spike to about 60 and then a fail on the diesel front on the crack spread. You can still see where it's very high versus historics, but realistically around 50 is kind of the right number. We've had a sizable drop in diesel pricing on the wholesale side in the Midwest. That's something that should reflect through and act as a pretty sizable overhang when you look at crack spreads on the diesel front. But again, that's going to be something to watch and especially the spreads between the Gulf of Mexico and Pad 1 in terms of how those two communicate. So now when you look at distillate fuel oil inventory for Pad 1, things are starting to climb back up. It's still very much on the low end. The rate of change has been good, and a lot of this was driven by imports, additional capacity coming on the Colonial. But now as we have a pretty big pull down in what is in your home storage based on the cold snap, that'll then signal additional movements into the market, which will pull that down a bit and just keep it, just in a very tight spot as we go into January and really as we go into Q1, even as trucking continues to be that broader overhang. Here you can see pad 3 still well above normal, and that's going to stay the case. They're gonna, and as we said last week, they're going to manage this by just exporting. I mean, the market is still wide open into Europe, and that's going to be where a lot of this product is going to find a home, especially because when you look at product demand, as we were saying, we expected it to bounce along seasonal lines, but still be well below the 5-year average. That doesn't change. Things will flatline around here, and then we'll get a sizable drop once we get some of that refill following the cold snap. But again, trucking is just going to be an overhang. And then once people refill their homes with heating oil, that'll drop off again because that is lumpy. The small bounce in trucking, but you can still see that it's just right around where we have been when you look back through 17, 18, and 19. We don't see too much deviation against the 19. If anything, we actually see additional slowdown just because January, February are tough months. There's usually a little bit of a restock depending on how good retail sales were. They don't seem to be all that great, so we don't expect to see too much of a change as we go into next year. When we look at the rail traffic from the total car loads still down versus 21. Slowdown in chemicals, as we said last week, is going to be a problem just because petchem demand just isn't there. Coal, there was a big movement last week. Some of those different things will adjust. Then when we look at farm products, forest products, grains, that will remain strong. Last year was very strong, so it may be a bit below 21, but still going to stay well above average. With petroleum and petroleum products, as we said last week, we expect that to continue to be a bit elevated, just given the issues between pad 3 and pad 1. But then intermodal slowed down significantly. Some of that is seasonal. We should get a bit of a bounce, but again, intermodal is still going to be well below where we were last year, just because we don't have the same type of demand. We should see a little bit of a recovery as we go into next year for Jan, but we don't expect to see a huge increase, and here's why. When we look at vessels, Signal did an update. I always love updates because you get usually in an update you get more data, not less, unless you're Bloomberg, because they love to take away information without telling you. But when you look at Signal, you can see vessels at berth 10, average time, total planned vessels 90, total planned containers. And then when you spread it across the next few weeks, you can still see things are fairly light for this time of year. And when you look at current inbound, we have 5 coming, average time waiting 2 days, vessels within 40 miles, nautical miles 1. Now, that's the big one, because the vessels within 40 miles, if you remember back in November of last year, well through, let's call it March of this year, there was anywhere between 30 and 40, upwards to 60 at times, and to the point that they had to slow steam and really slow it down. That has now come to a trickle, which again just speaks to where that demand is going to be on the trucking side, on the rail side, as we go into next year. When we look out, you can still see things are going to stay fairly cold. If you just want to break it from the Mississippi east, things are going to remain below. Just touch to the west of the Mississippi, things are going to still have a bit cooler. And then as we progress into the end of the year, things are going to be either normal or slightly below normal on the East Coast. But you can see this heat coming across, starting from California all the way over into the Rockies, and then as we close out the year, closer to the Mississippi. So again, it's going to be fairly neutral for natural gas and heating oil, just given where the demand centers are. And there's going to be some severe cold from the when you look at between the 25th and 29th, which again is going to draw some down. And then as things warm up, it'll balance out to be fairly in line with seasonal norms. Gasoline here, you can see that gasoline had a build of 2.53 million. A lot of that was pad 1, with everything else having some small builds, small declines. But again, we're only 4.4 million below the 5-year. We're 2 million above last year. Imports slowed a bit. by 238,000 barrels, but you can still see it's well above the 5-year average. There's still more behind it, and it's just because there is so much in Europe that shipping rates came down a touch, which opened that up a bit. So again, it's just a matter of where that timing was and how that came over. And then when you look at previous years, you can see that we're still on track. We're likely going to take out that 2017, 2018 level, and we do expect to close towards the higher end for the year, just given lower demand. As we've been saying, refiners are still trying to make as much diesel as they can, which throws off gasoline, and exports continue to be, not a big thing in terms of where it is in the market, but enough to the point where with supply increasing, with demand falling, and then whatever comes, imported into the U.S. is going to show up in a sizable way. And then when you look at blending components, just giving you an idea of where we are, blending components had a build of 2.27. That's 3.8 million above the 5-year, 6 million above last year. And you can see that this is the only times it was higher was 2020 and 2019. And given, as we've said, the slowdown in petchem, the issue with demand, we do expect to actually most likely close at the highs ever, or at least in line with 2019. Because if you remember back when when I was only doing writing insights before we started the EIA show, we were talking about what was happening on blending components, and our view was in 2019 that petchem demand was falling considerably. There were a lot of issues with the economy, and that put a lot of that product. So again, we see something very similar in 2022 that was happening in 2019, which is why we think we're going to close right around there. When you look at what Gas Buddy was expecting, they were expecting that 8.6 million barrels a day for the gasoline front. Again, it all kind of averages out when you put it all together. We expect this to creep higher again, just because of the holidays, and then they'll drop off with that week between Christmas and New Year's, and then a little bit of an increase, but then we do expect things to weaken considerably as we go into the second and third week of Jan. Tom congestion showing a bit more of that normalcy as we go into the end of the year. We do expect that to flatline a bit, and because remember, people driving, and then we do expect that to drop off. And it happened a little bit earlier just because of the storms that are coming across. I think it's Winter Storm Elliott is what it's called. That is going to cause either a lot of snow, a lot of rain. But then when you look at China, as we had been saying, we expected the Chinese demand and activity to drop off considerably, just because as things normalize in China, you're going to have an increase in infections. And if infections increase, well, why are you going to go out and risk yourself? So you'll naturally slow down. And we don't expect a lot in Lunar New Year. I believe this year it's the January 22nd is when Lunar New Year falls. And typically that is a big year, a big day. There's a lot of things that lead up to it, the week before, the week after. And we think that that's going to be fairly underwhelming in China this time, similar to last year. And now when we look at gasoline prices continue to fall. We're back to where we were in the end of 2021, which is a positive. It's just going to be a matter of where is crude? Does crude continue to come down? And where is storage? Diesel is at 472. It's broken through that 485, which is kind of where I thought it was going to stop. Instead, we had a nice little drop. As we get a little bit of that refill, again, on the heating side, it'll flatline. But as long as demand for diesel stays here and things remain a bit warmer and storage continues to repair itself on the in pad 1, that has a clear direction to about 450 in the near term. Now, when we look at gas in terms of, gasoline, in terms of demand, you can see that we're just above 2012, and we don't see, we see one more upside move, but you get an idea in terms of where we are and how there's not too much and how we're still very much below where we should be this time of year. Propane had a nice draw of 2.92 million, still 11.9 million above the 5-year. And you can see that blue line is 2016. So again, rate of change is very much in line with previous years. So we're starting from a high end, and a lot of this is driven from all of that cold, a lot of that, the winter bomb, if you will, which was the big driver. And then there should be another one, which is going to be positive for demand. But as long as petchem remains weak and supply remains elevated, which it has been, the rate of change is going to hold this course, and we're going to close out the year at a fairly high level in storage. Jet, small build of just 10,000 barrels. Demand is right at that 1.7 million. We do expect to see a sizable drop and really stay within our comfort level of that 1.45, 1.55. And here's why. When you look at TSA, passenger throughput, Eurocontrol area, we're still well below normal. We don't see that changing when you look at the activity, especially as people, try to do less, try to save money. So we don't see too much of a shift. And then when you look at TSA passengers, layered over, you can see here that we're still well off of where we were in 2019. And actually, we've been tracking much closer to 2019 highs, and we're just not really getting there. We expect that to be the case. We should get one more spike just because of the holidays, but then it'll drop back off, and we expect to be below where we were in 2019. And then as we get into the new year, you can see where 2019 and 2020 were. We expect to be below that again. Then when you look forward, just kind of giving us that confidence, the passenger flight schedule for the 12 weeks ahead is only 0.04% higher than it was last week. So again, we're not adding back any more flights than we have been in the past. So there's just really not enough physical capacity to move more people to increase that demand until we see that normalizing closer to where we were pre-COVID. And then on the open table side, things continue to slow, remaining on the lower end. A lot of that is obviously seasonal, but also when you look at just prices to eat out remain elevated, going higher. Inflation still remains a problem. So we do expect this to remain fairly sluggish and continuing to underperform previous years by about, let's call it between 4 and 7%, which is still good given where we are, but there is more downside, we believe, as the consumer continues to struggle and actually get worse into 2023. So that's what we have for you on the U.S. side. In the next segment, we're going to go deeper into the physical market differentials and where things are going to go into 2023, because we do see a lot of volatility continuing.